This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
The fading of the bounces, the whipsaw news flow, seeing the markets headed lower, and this week we'll digest what is knowable, a few scenarios about what is unpredictable, and give you a conclusion to be careful out there. Welcome to the Wise Investor Show podcast. I'm Chase Hinderstein, and I'll tell you, it's hard to invest in a market when there's circumstances, those that have a tangible impact on the economy and corporate earnings, that they change day to day and now sometimes hour to hour. There was a time this week when I actually saw, pulling up the Wall Street Journal webpage, you pull up their page, and there were conflicting headlines on there regarding tariffs and trade policy. Both posted, they're right on the top of their homepage, but because it's changing so quickly, they're actually conflicting stories side by side. And I'll reiterate this a few times today, but when I say it's hard to invest in this market, I don't mean that I'm struggling here, or when I say we, I don't mean the Wise Investor Group. The point is that this is sentiment that is leading the markets lower, and that we collectively as a universe of investors are feeling that as a consensus. You know, maybe not everyone. Maybe you'll still find some strong bulls out there speaking with great conviction, just as you'll find others out there, all too many maybe, that are going to tell you that this was predicted 700 years ago, and that's why you should buy this special type of snake oil that they're selling. But when the market was built upon lofty expectations for robust growth, not for the earnings we'll see this year, but also for the years to come, next year, the year after that, and so on, and that growth is called into question, and that notion is batted about hour to hour, well, you're going to see people wanting to circle the wagons, and they're going to just want to take some risk off the table. Surely not yet to the point where we've seen any type of really ugly capitulation. Really not even technically a correction yet. Not so ugly that we can go out there and say, buy bargains. There's companies out there that are selling at pennies on the dollar. But definitely some of the hot air is coming out, especially from those names over these last couple of years that were flying so close to the sun. And, you know, the markets were and they are ripe for correction, which kind of really hasn't happened yet, right? I mean, it's hard to record this or say this today. The S&P, as I stepped into the studio, is down about 6% for the year, and it's just a wee short of being a 10% decline from its all-time high at the moment. So I guess by the time you listen to this or by the time the week's over, it's a fair bet that the folks over at Barron's are going to be able to run a cover story this weekend, calling it officially a correction. Over at the Wall Street Journal, it's actually the same company that owns Barron's and publishes them. They wrote this week, quote, Trump inherited an economy with steady growth and lofty stock markets, but vulnerabilities from a frozen housing sector and a cooling labor market, end quote. Well, also they go on, same article, quote, investors began the year indifferent to those blemishes because they expected the new administration to focus on revving up growth. Stocks soared after Trump's election in November as investors anticipated a bullish cocktail of tax cuts and deregulation as occurred in his first year as president in 2017, end quote. Well, you may or may not recall that in podcasts, which I recorded in December last year, I predicted or at least theorized that the first couple of quarters this year we're going to feature volatility from the focus on tariffs, which were promised, while the elements of the new administration that would ultimately help business and the markets would probably come later on, maybe in the second half of this year as they start to feel the benefits from lower regulations, higher M&A activity, and the confirmation of continued lower tax rates, if not even lower rates. Those are going to show up later on. So it's in there in our archive, and that this is what we would see, and that we would see then tailwinds applied when those effects start hitting later on, especially if it's in the face of a much cheaper stock market. Well, this isn't to say that we're not playing with fire here. Again, the collective we. The timing of all of this is up in the air, and that's what this market is struggling to digest. The capital markets can adapt to. They can model for anything except for the unknown. and tariffs on, tariffs off, tariffs on with exceptions, do the hokey pokey, turn yourself around again. That's too hard to factor into the models. And also impossible to know now is the timing of this. The tariffs being imposed and suggested now are larger than were anticipated, but what's unknowable is if they're going to be in place for a couple of weeks, after which Trump can take credit for some agreement that's trumpeted as this kind of reinvention of global trade agreements, or if our partners and our opponents stand firm and the administration can't garner a victory, but instead they stick to their guns for a year or more, and the tariffs maybe have a far bigger effect on the economy. It's playing with fire in that if it was mapped out perfectly, and it's hard to believe they'd even deliberately planned it this way, and harder to believe that it could be executed this accurately, because what I'm about to suggest is harder than the shot that Luke Skywalker used to take out the Death Star. But that perfect shot would be something like imposing tariffs, get gains for the U.S., actually allow for a softening of the economy in the U.S., along with, therefore, higher unemployment, hopefully without too much inflation to go along with it, therefore allowing the Fed to cut interest rates to try and address the unemployment situation just in time for the tariffs then to be resolved with new global trade agreements, along with then the effects of lower regulations, a flood of liquidity, abundancy of labor leading to a boost of corporate activity, leading to us to be able to bounce off the surface of what is otherwise a modest recession and into this bright economic future. Now, again, it's hard to believe that they would even kind of steer the ship trying to do that, less actually being able to execute it that perfectly. But hopefully they're using the force, right? And we'll all be okay. Really, I wouldn't buy into this as any kind of baseline. This is definitely not my baseline for assumptions right now, or a rough outline of where they want to be, because the one thing we've learned is to take Trump seriously with what he says. Be wary, be careful with the people out there, the third parties that say it's just a bargaining tool. What he says is just a bargaining tool, but watch him when he says it and then he does what he says he's going to do. Trump and his Secretary of Commerce continue to message that they see tariffs as a lasting, permanent, and gradually increasing state of affairs. They want to change the name on the mountain back to McKinley for a reason. It's because they liked how President McKinley was doing things. Secretary Lutnick, who may be falling a little bit out of favor, so we'll see if he's still around in a few weeks, but he has said publicly that he'd like us to return to how the country was in 1900, which was a time when we had no income taxes at all. We only had tariffs to pay our bills. But of course, not only would that make the tax system very regressive, but in 1900, and I had to look some of this up, of course, but the federal budget in 1900 was spending on the defense space alone was under 2%, which is over 15% today. There was, of course, no VA. There was no Social Security or Medicare. We didn't have massive interest on this terrible debt. We didn't have a national highway system, and many, many other budget items that, just can't be dozed away. So we can take them for their word, which is what the market is doing, while it's not reacting well to what it's hearing here. In the end, it requires just too much faith and optimism to leverage to that thesis of a few moments ago, threading the needle and everything just breaking perfectly. So therefore, we, once again, the collective we have to reduce our confidence and exposure to risk, which is what you see the markets are doing this year. All right, I'm going to jump to a quick break here, and when I return, I'll take a look at the latest from the Fed and what they're messaging about this shift in our economic game plan. For the Wise Investor Show, I'm Chase Hinderstein, and I'll be back with that in a moment.
Almost everything that lagged last year, value, international, and more defensive stocks, are first out of the gate here in 2025. Is this a knee-jerk reaction or a more sustainable trend? Tune in every week to hear Simon Hamilton and Chase Hinderstein discuss the latest financial trends and what investors need to know. To learn more about where to find the best future opportunities and how to become a better informed, wise investor, listen to us at The Wise Investor Show at RaymondJames.com/The Wise Investor Group, or just find us on your favorite podcast app. Raymond James Financial Services Incorporated, member FINRA SIPC.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.
Welcome back to the show. We've spent endless hours over the past few years vamping about what the Fed might do and what some data means about what the Fed might do. And now, after it seemed like we had set course for interest rate cuts, still the markets are pricing in 3 cuts this year. Tariffs are now causing some out there to reconsider the conclusions there, while others, including apparently those at the Fed, are not so quick to change their minds about the cuts, and they're still expected to come this year. The Wall Street Journal said, quote, because tariffs are likely to send up prices at least in the short run, officials at the Fed are likely to move more slowly to cushion the economy from potential threats to growth than they were last year when interest rates were higher and inflation was steadily declining, end quote. But one thing that did help the markets briefly recently were comments by Jerome Powell in which he seemed to indicate that the price effects from tariffs would have to be recognized by their limited effect on prices instead of being taken as a trend on inflation. They cause prices on those goods to rise, but they don't continue to do so quarter after quarter or year after year, although that higher price may surely persist, but inflation is more about the trend there. On the other hand, though, reciprocal tariffs and reciprocal tariffs on reciprocal tariffs can lead to inflation, not only from the spiral in price hikes, but also from supply chain disruptions. You might see some scarcity. It can create problems with goods overall. Remember, we collectively don't care about what Powell or the other Fed representatives say because that it informs us as to what they're thinking. We care, we listen because not what they're saying about the economy, but what they're thinking may give an indication of their actions, and we can interpret that with what we think about the economy. We can look at the data as it's available, and we draw our own conclusions about it. But we looked at Powell and his constituents to give us this view as to how they may react when they see what's in our headlines right now. Will they make cash cheaper? Will they lower interest rates? Will they continue or discontinue quantitative easing? This past week, we had 2 big data points, which will lead up to the more supposedly important PCE data coming up. But we had points whereby the consumer price index, it came out actually below expectations, lower rates of inflation, and the producer price index was right about at the consensus estimate. And that was a signal that inflation was moderating, and it gave a bit of a boost to the markets, but it was a pretty brief boost. Now, when Chairman Powell spoke last week, he said that there are 4 areas that the new administration is implementing change on the economy. And they are that they're affecting trade, obviously, immigration, and Powell has for some time spoken about immigration as it has its economic impact on labor. Obviously, changing fiscal policy, shrinking government, cutting spending, and regulation. And while it was encouraging that he telegraphed that the Fed could absorb the expected price increases from tariffs without making a major course correction, he also said, quote, we do not need to be in a hurry and await clarity, end quote. Going on to indicate that if tariffs cause a one-time spike in prices, then it's not appropriate to react to them. And the market reacted well initially to that, thinking that at least if the tariffs do create turbulence, that the course of our monetary policy won't change because of them. But the problem arises if the tariffs aren't just a blip in the data, but reciprocal and reciprocal, and then so on. If that does cause turmoil and increasing price turmoil, well, that then does require monetary policy attention by the Fed. Over at Strategist this week, though, they said, quote, this is a long one here, Our back-of-the-envelope math suggests that the combination of the 20% additional tariff rate on China and proposed 25% tariff rate on Mexico and Canada would be a $150 billion tax increase in 2025 should it fully go into effect, roughly the equivalent of raising the corporate tax rate from 21 to 31%. This is unlikely, but not going away. We have argued that tariffs are deflationary, and financial markets are now coming to this view. Still, much of this reminds us that of December 2018, when the S&P 500 fell 20% in 1 month as Trump's tariff policy and a tight Fed collided, end quote. And strategist, who is very pro this administration, said that. And the problem is that this was part of a larger report that was attempting to assuage our concerns about what the markets may do, and they're doing so by pointing to a 20% decline in the S&P 500. And another opinion, the chief economist over at Apollo Global, Torsten Slok, he said not only that the Fed's taken a wait-and-see approach, which is what many have been focusing on and we've been talking about, but he went on additionally and he wrote, quote, "What characterizes a wait-and-see economy is that consumers and firms are more cautious about spending decisions. Consumers are more reluctant to plan vacations, to buy cars, and to buy new washers and dryers. Similarly, firms are more reluctant to hire and more reluctant to do CapEx," end quote. And there was enthusiasm in business from the expectation of lower regulatory hurdles and cheaper capital available, as I said earlier. And that may still be the boost we get on the horizon in the next phase. But for now, it's clear that their confidence is shaking. Slok went on to say, quote, "The bottom line is that a wait-and-see economy eventually leads to a slowdown in the hard data, and markets should prepare for that scenario," end quote. And the problem with the wait-and-see economy, this is me now, is that when the consumer and the corporate decision makers are cautious in the face of this uncertainty, it's that, well, it can be that subtle enough push that rolls the economy into a slowdown or an outright recession. The fear of recession can lead to a recession, and while the data in many areas today is not pointing to one, there is evidence of this behavior, and that may ultimately prove to be the tail that wags the dog. Lastly, for this week, some more evidence here, some anecdotal evidence of this, both about the consumer and the corporations pivoting to this kind of wait-and-see approach. JP Morgan hosted their industrial conference, and we gleaned quite a few notes from what the airlines were saying there. And actually, the whole conference had a lot of relevant pieces, a lot of good insight into the economy, ones that you may very well hear me call on in the future, but we were particularly struck by the airlines. And the CEO of American Airlines, who slashed their 2025 guidance, and this is according to JP Morgan's report on it, they included weather, the LA fires, general safety fears as reasons for cutting their guidance, but their focus was increasingly on macroeconomic uncertainty. And to us in this area, we think of as American as this big provider out of DCA, and that also government travel may be way down, and that could be part of it. But the American Airlines CEO made a point of saying that only about 1% of their revenue is from government spending and travel. At Delta Airlines, which appeared at the conference a day after they slashed their guidance for the year, their CEO said that Delta is seeing weakness in both consumer and corporate confidence. And for what it's worth, he was bold enough to say that at least half of the revenue impact was, quote unquote, transitory in nature. And I didn't think anyone was going to be comfortable using that word ever again. But reassuringly for them, not for me, I guess, he said that the weakness remains limited to the main cabin, and that the demand for premium seats remains intact. But since I'm using this not to analyze the airlines, which I have a kind of a policy of not really taking seriously as investments, but instead I'm using it as a take on the economy as a whole, that too is telling that the premium consumer, well, yeah, they're still out there doing well, but the average one is having some confidence problems today. In the end, the biggest challenge remains, even if we take everything at face value, the timing is not known. I think that we have a good model for what is next, for what turns may look like ahead. It's just very unclear of how fast we're going to reach those bends. And as such, like so many out there right now, we just have to remain that much more cautious. For the Wise Investor Show, I'm Chase Hinderstein. Thanks for tuning in this week.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.